This video will guide you through how VisionWorks, our next-generation life planning software, can take your financial planning business to the highest level.
Thank you for your time today. This is the second of our open Q&A session. And I'll just remind you that if you can't attend but do have some questions, please send in an email and we will review them. So today we have two write-in questions. The first is, how do you effectively model the transition for a self-employed person into retirement? When self-employed, the phone, internet, car expenses are paid by the business. Once the business is gone, those items are paid personally. When initially adding the information to VisionWorks, would you add, for example, the phone as a business expense, and at the same time go to home operating expenses and add the phone again, but at the future retirement date? Will you remind me how to enter the percentage of business vehicle use? So first of all, let's just bring up VisionWorks. And I'll go to Bill, and I've created a self-employed entry for him. And you'll notice that there are two buttons. One is percent of home office expense, and one is percent of vehicle expense. So I want to remind you that not all of business expenses are paid by the business. It's only a percentage of those expenses that are paid. So if we have a look at the home office expense, for example, you'll notice that it's 10% of the operating expenses for a home. So if I go to joint in the home entry and look at property taxes, $5,000, operating expenses, $4,000, and they're being inflated through the course of this year, and what I'm going to, and thereafter. So what I'm going to do is I'm just going to go into 2024 so we can see the full year. And you'll notice if we go to sources career, that the business has now got a home office expense of $936. That's the $4,000 plus the $5,000, that's $9,000. Inflated at 2% this year is $9,018 plus another, $9,018. 9,180 plus another 180 next year to the end of the year gives you 9,360, 10% of which is written off. So it's just a write-off. Those home expenses will continue over time, but they're a deduction as long as there's business income. And then once the business we can see the operating expenses continuing over time. But once the business income or business ends, they're no longer an expense, in this case, 2030, so they would no longer be deductible. So we actually don't have to do anything. We just have to put in the percent of home office use. If there are expenses which are exclusively being paid by the business, whatever they might be, and if those expenses will continue on, then we would model them with the business, and then we would have to separately model them, once the business income ends, starting, let's say, in 2031. Same thing with vehicle expenses. What we can do is we can put in a percent of the vehicle that's being deducted. And I'll just remind you that when you do that, because people can own multiple vehicles, that you have to go to the buy panel and select that business use checkbox. And when you do, what will happen is that the business expenses, 30% of the vehicle expenses, will be a deduction. But in addition, there are other deductions besides just operating expenses. That percent of the depreciation is also a deductible expense. So you can see that this goes up in 2025 because in 2025 we buy the next vehicle and we're deducting a part of its depreciation as well. So again, all of that's taken care of. We still have the operating expenses for the vehicle. They'll continue on after the client quits working, but during the working years, they'll be deductible. So only expenses that are exclusive to the business while there's a business, but that somebody will retain those expenses once the business ends, then they would have to be entered separately. But otherwise, not all expenses, not all vehicle expenses or home operating expenses can be claimed by a self-employed person. So we're just deducting the appropriate percent, and the expenses continue, but we lose the deduction once the business ends. Another question that came up was about principal residence that's partly leased. So I'll read you the question. How do you model a rental in a principal residence? Do you add other taxable or non-taxable income, it would be taxable income, to reflect the monthly rent, or do you actually model a rental property for, say, 25% of the value of the home? When you model a rental property, do you add a property value? For example, if the home is worth $1 million, would you say the rental in the home is worth $250 and the principal residence is $750, or would you give zero value to the rental and keep the principal residence at $1 million? And the answer to that question is it depends. And the reason that I say that is because the renter could claim, make a CCA claim in this example on $250,000, that portion of the residence that they class as a rental property. So if that were the case, then definitely you would have to model the residence as being worth $750, and you would have to separately go, or $750,000, and you would separately have to go to other and model a rental property for $250,000, portion the operating expenses and property taxes for the home is 75-25, 25 as part of the rental property expense, only because the client wants to make a CCA claim on the $250,000. Now, the issue with that, of course, is if you sell the principal residence, then ultimately 25% of the value has to be taken into account as a rental property, and therefore would be subject to CCA recapture and a capital gain, both on the value of the building and on the value of the land under the building. So in most cases, it doesn't make any sense in the long term to make to apportion a part as a rental property and model it separately. It makes more sense to model the home and all of the related expenses. And then what you do is you just go to other income, other taxable, ongoing, and call it rental income. But what's important to do here is to put in the net rental income. And what I mean by that is if, for example, operating expenses are $1,000 a month, 75% of that is for the home, 25% of that is for the rental. If the rent is then, say, $2,000 a month, what we have to do is we have to reduce the amount of the rent by the proportion of those operating expenses that are actually deductible against rental income. So that would be $250. So what we would end up with is we would have the operating expenses for the home at 75%, 750 of the $1,000. We would have the rental income of $2,000 a month, less the amount that is the rental property related to the rental property, 250, and then we would get the net rent after those expenses, because a part of that $2,000 is being used as to pay for the property operating expenses. So we need to put in the net amount, and the net amount would then be taxable. So again, it just is a function of whether the client is making a CCA claim, which would not be particularly advisable. But if they are, then you would have to apportion part of the building as a rental property and model it quite separately, just because of CCA recapture and capital gains on the building and on the land. So those are the two write-in questions for this week. Does anybody else have any questions that they'd like to ask? Anyone? Okay, well, thank you very much for your time today, and I wish you a great weekend. Thanks.
Book a demo. We'd be happy to show you more of VisionWorks' incredible features.